Historically, do lenders call the loan due? Not really. You don't see it often. But when they have money out at 2.5% and they have a reason or an ability to call that due and relend it at 8%, don't you think it's in their interest to do that? And I'll tell you a story that's going to shock you about this.
This podcast is for informational purposes only and does not constitute financial, legal, or investment advice. Please consult a professional advisor before making decisions based on what you hear on this show. Wealth Without Wall Street Tribe. I want to introduce to you Mr. Bishoy Habib. Bishoy, glad to have you on.
Thanks for having me, fellas. I'm excited about this one.
Bishoy, I've been watching YouTube. I've seen the Pace Morbies of the world talking about subject to and how I can buy a house with zero down, get 2, 3, 4% interest rates today when rates are 7 or 8%. What is the mistake that most of these investors make in that first transaction that they didn't anticipate that they need to understand from a legal perspective?
Subject to deals can be very fun, and you can put zero money down and you can cash flow without really putting any skin in the game. The biggest issue with subject to deals that you have to be aware of is that you're still married to the other party after the deal closes. And so if you're a buyer, there's a potential risk that the lender could call the loan due at any time. And so I'm here to mitigate that risk. As a seller, your credit is still tied to that buyer's performance on the note. And therefore, the parties, as I like to say, they're still married to each other after the deal closes. So they have to play nice. And that's why it's important to have an attorney involved who can make sure the parties play nice by preparing the documents properly. That's the big risk with it.
If you've listened to our show for any length of time, you've heard us talk about infinite banking and how we were able to use that concept to create over $50,000 a month in passive income. But it's just not that easy to figure out, how does this all connect into my own personal system?
Stanley, that's why we created the passive income operating system, bro. It shows you how to turn active income into passive income. It makes all the steps come together. If you would like to get access to it as a podcast listener, we've never given this away in public before. Go to what'swhatwallstreet.com/PIOS.
Before we go deep into this episode, because I know subject to is a topic that we've touched on, but very surface level. But every time we have a guest, we love to know kind of, what's your story? Why should I be listening to you? Are you just here to sell me legal services? Or are you like me? Are you an entrepreneur? Are you an investor? So a little bit about your investment background, what you're working on personally. I think that's super helpful for our audience to hear.
Yeah, entrepreneur first, attorney second, business-minded, deal maker. Grew up in real estate. My dad was the immigrant story. My parents really came here in the 80s. Didn't know the language, didn't know the culture. My dad just hustled his way through, learned about real estate, was buying foreclosures on the steps of the courthouse, literally, in the 80s. And I grew up in that. So I was always driving around his properties. I negotiated my first commercial lease at the age of 15 years old on his building with the state of Florida as the tenant. I always joke, I don't know how much I actually did. I felt like the man. But anyways, that kind of, pushed me into the legal field. I was like, well, this is cool. I'm good at this. Got my law degree. Didn't really plan to practice law, to be honest with you. I just wanted the law degree and I wanted to go into real estate investing, but the market was soft in 2012 when I graduated. So I ended up moving to New York, took my first job in New York as an attorney, worked up there for 2 years, worked for a hotel developer, the largest hotel developer in Manhattan history, Sam Chang. In that time, I really learned how the big deals function, from acquiring land, construction, a construction loan, building it out, taking out the loan with a permanent financing, disposition, ground leases, all those big things we didn't have in Florida, Orlando, where I grew up in the 90s. Now those deals are more prevalent here in Florida where I am. But at the time, it was earth shattering for me. And so those 2 years really changed my, my trajectory, I would say. And then I kind of fell in love with it. I started doing it more. I came back to Florida, worked on big deals here. I did the Orlando airport deal. That was $1 billion transaction, and just kind of worked through the finance side of things, the real estate side of things. And after 11 years of doing deals, I broke out on my own, started my own law firm, which is 2 years old now. All in all, I've done 13 years, over 1,000 transactions. It's probably closer to 1,500 at this point, $13 billion in transactions over my career as an attorney. And then on the investment side, I've invested in a lot of the deals that I've been a part of as an attorney. I have some other various investments. We could dive a little deeper into that if you want to know. But that's kind of my story. I'm a real estate guy through and through. And I always say I'm a deal making attorney. I just like to get deals done. I like everyone to get paid. I have a litigation department behind me, but truth be told, that's a last resort because I like to figure out a way to make this all work, to structure, to negotiate, and to close deals successfully.
That's a super, super great story to understand your background and how you are kind of aligned with the people we're talking to every day on the investment side. I want to dive into the specifics behind subject to, and I'll be honest with you. Russ and I bought a subject to property without knowing all the things we're going to talk about today. And I think more people would take action in finding deals subject to if they knew what we're going to uncover today. So that's my goal with our conversation, is to demystify the process from the time someone says, yeah, I'll let you take over the payments on my mortgage, to the time that they now start actually paying those mortgage on their behalf. Like, I'd love to kind of just take that whole process. So before we get into it, could you just define, for somebody just learning for the first time, what does the subject to actually mean? In like, just break that down for that person.
Absolutely. So subject to just means I'm buying a property. There's a loan on the property. I'm not paying off the loan, or the seller's not paying off the loan. I'm taking the property subject to the existing loan. The reason someone would do that is because we are in a high interest rate environment. Maybe if I was an investor, I would have to pay 8% interest on this loan, but you have a loan from 2021. And so you have a 2.5% interest rate. And so that spread of 5.5% can be the difference between positive cash flow and negative cash flow. In other words, the deal doesn't make sense if I have to pay 8% interest, but it makes a lot of sense if I can pay 2.5% interest. And so that's the whole reason behind the subject to transactions. They really blew up during the interest rate spike in 22. And ever since then, they've been the hottest thing. They existed before that, but that's when they really took off because rates went from 2.5%, 3% to 8% on properties. So that's kind of the backstory.
Well, and if you think back to the 2009, 2010, when we saw such a decrease in prices, like the values of homes went down, you also saw a lot of subject twos happen around that time, not necessarily rate driven, but because you could get into a property where people were started getting, like, they had to sell, and it was an easy way to just hand over their mortgage rather than take a loss if they had to sell it on the retail market. So there's different variations of things that drive people to this as a solution to their real estate problem, just in case you're kind of learning this for the first time.
Bishoy, what would make this different than, seller financing or lease options from a legal perspective?
Well, it's a little bit different. The seller financing, you have to own the property free and clear or have equity in the property. A lot of times these subject to deals have very little equity, right? Because if they had equity in the deal, and I say equity, you might have 5 or 10% equity, but you need more than that to make money. Your break even, if the property's worth if the property's worth $500,000 and I have $450,000 in debt, that's break even, right? So if you sell it, you're not going to make any money. Or you could have negative equity. And that's what we're seeing a lot of these days is people in distressed situations. They can't afford to make the payment. It's a second home. They're leaving Florida. I'm in Florida, like I said. So a lot of people are leaving because it's become too expensive. And so it's a little bit different. Seller financing, you can control your own destiny. There's also much less risk. There's still risks. There's different risks between like seller financing and subject to. But the point is, with seller financing, the seller still has control because they're technically the lender. So they can call the shots. There's less risk in that sense, versus this tri-party arrangement that we call the subject to transaction with a buyer, a seller, and a lender. Seller financing is just a buyer and a seller / lender. And so it's a little bit different. I do both. I do all kinds of creative deals. The subject to is, in my opinion, it's the most risky, but it could be the most rewarding if you can make it make sense like PACE teaches you.
Well, and thank you for kind of clarifying that. Now talk about when someone has gotten that call, they've gotten the person interested in doing the subject to deal. It is the actual solution to their problem. what are the like key documents you're going to then put in place or help that new buyer put in place to protect them?
All right. So I'm going to give you some secret sauce here. First thing, this is not secret sauce. You want to prepare a good contract, right? And so a lot of times what my clients will do is they'll just tie the property up with a very simple contract, but they'll give themselves enough due diligence period so that they can back out. In that interim time, they come to me, they say, hey, these are the terms, prepare your contract. I have a special subject to contract that I prepare for my clients that has a lot of different stipulations and conditions and requirements, right? So you might want to lock it up with a very basic contract, but eventually you're going to want to either transfer or novate that contract with the new contract that I prepare, whatever the case may be. But that's important. It has special terms.
But Joey, when you say a specific time, if I'm going to do that, I want to hear the rest of the story. But like the first thing is, how long, when I put together a contract, is an appropriate amount of time to do my due diligence so that I don't make the mistake of not having enough time to contact you and get the adjustments made to improve the contract?
Well, look, so you always want to push for the longest due diligence allowed, but I would say minimum 10 days. 14 days is a good time period I would push for. If you can get 30, you can get 30. If they say 2-3 days, that's kind of rough. You could still take the deal and call me. I move quick. I move quicker than any other attorney you know. And so I can get it done if you call me the day it happens and say, I need this, right? So we can get it done. Just make sure you have an out is really the point. And for me, when I talk to my clients, and this is general advice, you want to maintain control of every aspect and every turn of the deal as best possible. And having that out gives you control because it allows you then to go back to negotiate, renegotiate, whatever you need to do. If you find something with the property, there's another lien on the property, you got to deal with X, Y, Z that you weren't prepared for. So you always want to optimize and maximize that due diligence period. 10 to 14 days minimum would be my suggestion. Once we get the property under contract, and here's the secret sauce, and we didn't even dive into this yet, the biggest risk to the buyer of the property is the loan being called due. Now, a lot of your listeners may know this, but for those who don't, when you prepare loan documents, every single good set of loan documents has a due on sale clause. And what that basically says is that if the owner of the property sells, conveys, transfers, anything like that, any sort of conveyance of the property, even if it's like a 10% interest to someone else, the lender can call the loan due. Historically, do lenders call the loan due? Not really. You don't see it often. But when they have money out at 2.5% and they have a reason or an ability to call that due and relend it at 8%, don't you think it's in their interest to do that? And I'll tell you a story that's going to shock you, a little side story here about this. During COVID, when banks weren't making loans because nobody was borrowing money because the rates spiked, commercial lenders, they had their loan officers, their LOs, reading through covenants and debt service covenants and all kinds of covenants to try to put people in default. So much so I had a church client, a client that was a church, had millions in the bank, big church, great client, had loans out. We had a guarantor die and the bank tried to put us in default. They didn't say replace the guarantor. They tried to put us in default and get the default interest, which was the shadiest move I've ever seen. But I tell you all this to say there's always going to be an ulterior motive if they can take that money back at 2.5 and relend at 8%. And so it's a very real threat that they'll call the loan due. And so all this is to say there is a way around it. It's not 100% foolproof because nothing is, but we create land trusts. Okay. We move the property into a land trust. And then what we do is we transfer the beneficial ownership of the land trust into the buyer. And this is kind of the secret sauce. This is what I do for my clients when we do the subject to package they call me about. There's other documents involved, but the reason we do this is because it makes it more difficult. Two reasons. Number one, it makes it more difficult for the lender to track who owns the property, so they're less likely to call it due. Even if somehow they figure out that the original owner doesn't own the property anymore, there still could be some defenses to raise, right? So without going into all the details, that's the gist of it.
There was nothing worse than walking into class when you're in school and the teacher saying, "Pop quiz day." Why? Because you were unprepared. Are you unprepared, though, for financial freedom?
Don't be. Find out how close you are by taking our 30-second quiz at wealthwithoutwallstreet.com/quiz. Wealth Without Wall Street Tribe, do you want more ways to build wealth and live free? Then you got to check out the Lifestyle Investor Podcast with our friend Justin Donald. He's interviewing top investors and showing you how to design a life on your terms. Check out the Lifestyle Investor Podcast and subscribe today.
By it being in a land trust, how does that protect that buyer from not getting the due on sale? Like, help me tie those two together. The due on sale still applies, but because it's in a land trust, it can't be like followed through or.
So I'm an attorney. Russ is buying the property from you, Joey. If we just deed the property from Joey to Russ Morgan individually, anyone in the world can go on there and say, well, Joey doesn't own the property anymore. Due on sale. Boom. What we do though is you call me, I create the 123 Main Street Land Trust, which Joey owns. Then, because land trusts are private, now this is the key, and I like writing a book on land trust. I'm the expert on it. It's what I do. In Florida, we have the best land trust. It keeps you private, it protects you, and there's estate planning benefits. But the key here is it keeps you anonymous. So they don't know who owns the beneficial ownership interest inside that land trust. So now we're transferring, it's technically personal property, the beneficial interest from you, Joey, to Russ. The lender, it's literally impossible unless someone tells them who owns it. It's impossible for them to detect. And that's kind of the point. Now, what I get questioned on all the time is, well, Bishoy, isn't this illegal what you're doing? Can I go to jail? Is this criminal? And the answer is no. You're breaching, if you really want to get to it, you're breaching your agreement with the lender, right? It would just be like if me and you had an agreement and I defaulted. It's a civil matter. It's not criminal. It's not illegal. It's just a violation of that contract. What is the recourse? All they can do is call the loan due. That's their only recourse in that situation, right? So, you don't want to think like you're doing something super shady. You're just trying to find a way out if you're a seller out of a bad situation. And if you're a buyer, to make the best out of a situation that's unfortunate, So that's a question or a pushback I get all the time. And I like to clarify that.
No, it's good. By the way, if you still want more details of the why, right? I think if you haven't done one of these transactions or haven't heard about subject to, we've done several different podcasts with Pace Morby. You can go and listen. One of the ones we did is the aha moment to building a massive rental portfolio with Pace Morby. Just Google that one, or creative financing options for real estate investors featuring Pace Morby. Both of those are on our website that you can go and listen to the why, because it is, like you said, you're trying to find a property. It may be an investment property. It may be your personal residence that you're trying to acquire, and the person leaving has to have a reason. They're not going to do it because they I got all this money. I think I'll just do Joey a favor and hand this transaction over to him. That's not. It's going to be like they have to have this. They don't want to default on their schedule. They're moving across the country and they're forced to sell the property. And as Joey said, maybe they're underwater, and you're the person that can come in. If you can actually pay them more, right? Give them a higher purchase price if you can take over the mortgage, which allows your monthly payment to be less, right? Like, you don't really care about the purchase price if your monthly payment is, 30% less or 20% less or whatever it may be because of the interest rate. That's why this becomes a good deal for you. So you talked about one of the elements there of how you're protecting the buyer is from the due on sale clause, right? There's also other elements to this. And Joey and I ran into this as we were having to deal with the insurance, right? You have to have the insurance available to you. You have to be able to actually make those payments to the lender, so that you get to keep the property. What are some of the documents that you use to help make this as a buyer simpler? Because we didn't have any of these things available to us. We were just, like winging it.
Yeah. And it's the classic entrepreneur story, right? Just flying by the seat of your pants, giving it a go. And I love it. I mean, you're my typical client. It's someone who tried it and maybe didn't go right the first time. So they call me, how do we make this smoother? There's a whole set of documents, like I said, in my subject to package that I kind of pitch to clients. And among those documents, they kind of cover some of the things you asked about. And the big thing is we want to, again, maintain control of the situation. And so how do I maintain control? One way to do that is to get an authorization to communicate with the lender. And that's the same document that the title company gets when they're getting a payoff, right? So you want to put them on there. And so that way, as the buyer, anytime I want to communicate with the lender, I can show them that. that authorization may or may not work in situations where you're requesting additional information or trying to change something. And so in that case, we could prepare a limited power of attorney, right? That's something I do on all these deals as well to help my clients out. Again, give them that control. We also want to give them web access, right? So there's usually some sort of a login. We want to transfer that information over or add my client, if my client's the buyer, as an additional user, right? So give them a username and a password for the portal, because there has to be a way as well for the seller to know that the monthly statements are being paid. And so a lot of times that's not a shared login, but both have logins to access the information on there. And with the insurance, you just want to make sure that the buyer is named as an additional insured on there. So there's different things that we do, different documents that we incorporate, and each deal can be different. There could be certain nuances. We have to add specific documents to it, but ultimately there's ways we have to protect it. Now, for what it's worth, on the seller side, I don't think we have sellers on this podcast, but just to share, it's interesting. What I can do for those people is it just gets your brain thinking. If you're a buyer, like, what does the seller care about? The seller cares about not ruining their credit. The seller cares about not getting a deficiency judgment after the lender coming after them for a deficiency judgment. And for those who don't know, deficiency judgment means you owe this much. The bank forecloses. The bank makes 70% of what they're owed. They come after you for the deficiency, 30%, right? Could be six figures. That's a no-go. A lot of loans have a deficiency judgment, a lot of residential loans. So those are the things that scare sellers. And so if I'm representing a seller, what I want to do is I want to make sure, number one, you have skin in the game as a buyer. How much money are you actually putting down? If you're putting $0 down and you're just making monthly payments, you will literally walk away from that deal in 2 seconds flat because you don't care if you can't find a tenant in 2 months, right? That's not a good situation. Number two, and this is the big one, we make the assignment of the beneficial interest, we make it conditioned upon payment being made every month. And if there's payments to the seller as well as payments to the lender, they all tie in together. So that if you stop making the payments, I don't have to foreclose on the property. I automatically can snatch back that beneficial interest in the land trust that we've created, and I can get that back within 30, 60, or 90 days, whatever the parties agreed to. I would obviously never include that in there if I was representing the buyer, but when I'm representing the seller, I have to. Why? Because we want you to maintain control as my client. Whoever my client is going to have more control in the deal. That's what I do.
But it makes total sense, because here's the thing. What I love about what you just shared is when you're trying to, and we've been in this position, Russ, sitting across from a potential seller and talking to them about this is a fairly new idea to that seller. Like, they may have never heard this before. And all of a sudden you're giving them this idea. Well, what does the first things that start flooding their mind are all those things you just mentioned.
And they're legitimate. They're legitimate concerns.
Yeah. And if you're not in a position to answer those with any sort of certainty, with either like the portal, being able to see if payments are made, or two, that, hey, this would revert back to you if for some reason the payments were made. Like, those are the things that make this deal actually close.
Well, one of the first questions they're going to ask is, how can I get a new loan when I still have this loan because I barely qualified for the last loan?
Yeah.
Right. Yeah. How do you answer that, by the way, Bishoy?
That's a little bit tougher. I mean, as long as the loan's outstanding, I had that call with a client last week. Actually, he's doing his second or third one with me, and he's like, "Can you talk to the seller? They want to know this." I'm like, "Hey, man, like, that is what it is. If the loan's outstanding, there's nothing I don't know a solution to that. So you may just have to get a DSCR loan or something like that, but you're not going to get conventional financing, based on this. So listen, it's not a perfect solution. It's not going to work in every situation. So that is one of those things that's tough, but the credit, the credit score, I mean, look, you can go from, as a seller, you can go from a situation where your credit's deteriorating because you're lis pendens, you're in default, you're foreclosed on, to a positive. If that buyer is making the monthly payments, you can kind of have that buyer repair your credit. You have to have a buyer that's doing what they say they're going to do. But if they don't do what they're supposed to do, they can damage your credit even further. And so that's another one of those risks. So it cuts both ways. It's a risky proposition. I don't say that to scare people, because where there's risk, there's money. right? And so we're risk takers, all of us, all three of us, everyone on this podcast. If you're listening to this show, you're a risk taker by nature, because that's what entrepreneurialism is. So risk is not a dirty word. I like the word risk, but you have to be calculated and you have to do what you can to maintain and mitigate that risk. And so that's what we're talking about. Not a perfect solution, but a good one for some people.
And I think maybe what you just said about the debt service loan that exists on a lot of properties out there, where they're using the income from that property or someone making the payments on that property to reduce it off of your DTI. Because I've heard, I think Pace even say this, after like two or three payments that you could prove someone's made, then the lender or the new lender that you're trying to get the new property under, that they would take off as much as 80% of that other payment if they could be proven that it was being made by someone else. So there are options. You need to be able to work through those details. But typically the person that's leaving is either in such disrepair they're going to go rent somewhere else. They're probably not going to go buy, that they're doing this deal, and they're like our situation, where the person had so much money that they were looking for the fastest transaction they could do. And we were just the person who could help them close so quickly that they didn't have to go through the whole sales process. And so we were able to do a deal with a very educated, very financially astute property owner. And they knew how this stuff worked. And we worked out, very backwardsly, but we got through the deal. Just kind of for the person listening that's saying, okay, now I'm kind of interested in this. Maybe I want to do these transactions. How, one, do they contact you? And then what does that typical engagement look like? And can you do deals only in Florida, or where are all your licensed to be able to help our audience? Because our audience is in, all 50 states. Obviously, there's lots of people listening in different countries as well.
Well, different countries I can't help you, cannot help you. I'm licensed in New York. I'm licensed in Florida. I'm getting licensed in Georgia. There are certain things I can do outside the state. I have clients who, I can consult and things like that. If it's deep in the trenches, I may not, but just call me and we'll find out if I can help you or not. I'm based in Tampa Bay, Florida. And as far as how people can reach me, I think you're showing it here. It's at Attorney Bishoy is on all socials. So Instagram, YouTube. I'm on LinkedIn with my real name, and then TikTok. I have a TikTok we were joking about before the show, but don't mess with me on TikTok. I don't check it. Just Instagram is fine. LinkedIn is fine. I check those all the time.
You dance and all that stuff.
I don't do dances. I do a lot of videos, but no dancing. I'm not the dancing attorney. I don't do personal injury, or criminal defense. But listen, the law firm's name is Legacy Legal. I want to help clients leave a legacy, and that's how I came up with that name. I do all kinds of transactions. So if you're buying or selling a business, I can help you. If you're doing real estate, obviously, that's my bread and butter. I work with a ton of lenders, banks, credit unions, family offices, private lenders. I do a ton with private lenders. They love me because I move quick. So any kind of financial transaction, you need an attorney, let me know. It's what I do best.
And let's just say I was not in one of those three states, Florida, New York, or Georgia, and I had to go find an attorney locally to be able to handle that transaction. Are there some good questions that I should be asking them to know if they're the right attorney to help me with that transaction? And then kind of B is, could potentially I have my attorney reach out to you and pay you some sort of consulting fee to educate them up in the event that they're not fully equipped to do it? Like Joey and I had a guy that we knew, great guy, good attorney, but just had never had experience in this one area. It would have been great to have you to be able to say, hey, can we pay your consulting fee to him so he could ask you all the correct legal questions? You could relay what he needs to do, look for to help us. Does that exist as well?
It cuts both. So I'll answer your second question first. It cuts both ways. And the answer is yes. There are times when outside counsel engages me for Florida stuff. I'm doing a deal right now with a dentist client of mine. He's selling his practice and his real estate in Maryland for $5 million. He's engaged me. I'm representing him on everything. When it comes time to do something very specific to Maryland, I'm going to engage local counsel to prepare like a deed for Maryland to make sure we're in compliance with the terms. But I'm running 95% of the transaction because it doesn't matter what state you're in. The deal's the deal, right? So it cuts both ways. Short answer, yes. And when in doubt, reach out. I'm always happy to tell you, yes, I can. No, I can't. To your first question, what do you want to ask attorneys? A lot of it is just making sure that you trust this person, that you feel like they understand the transaction. I would ask them about their track record with deals like this. I would also ask them questions up front. How long is it going to take you to do X, Y, Z? How much does it cost? How much is it going to cost? And those are very simple questions, but a lot of times if an attorney can't give you a good answer on those, it means it's going to be a long time and very expensive. And again, there's certain times where you don't know because the transaction could last 2 months, 3 months. But a lot of times, if I've done this 10 times, I could flat fee. I flat fee a lot of what I do, and clients love that because I know how long it takes me. And I get burned every once in a while, but I understand that's part of the game. So it's just, you got to make sure you know what you're getting into. The last thing I would want someone to do is get in with an attorney who they thought was going to do the work in 10 days and it's been 2 months and they've spent twice as much as they want. The work's not done. They're not happy. The attorney's busy. And that's actually how I get most of my clients because of those situations. But I don't like that. I don't feel good about that. So make sure you know what you're getting into before you hire an attorney.
Bishoy, it's been amazing to have somebody come on and demystify this whole process of creative finance subject to. So, man, just can't thank you enough for being willing to come on today.
Hey, I appreciate you guys. It's been a fun conversation. It's fun to geek out sometimes with other fellow dorks like myself, but I appreciate you having me on.
Oh, man, thank you again. And thank you, Wealth Without Wall Street Tribe. I'm praying that what we've done today is take one more hurdle out of the way for you to take action. Because as you take action, you're going to get closer and closer to your financial freedom. That's what we're here about. And to Bishoy's point, to leave a legacy that will live well beyond you. So thanks again for being on. Thanks for listening. And please share this, like it, subscribe, all the many things so that many more people can be on the same path to financial freedom along with you. See you on the next episode.
This has been the Wealth Without Wall Street podcast. Don't forget to subscribe to the show to break free of the Wall Street mindset and begin building wealth on your own terms in places you understand so that your wealth will never run dry. See you next episode.